I think a lot of entrepreneurs, and I will say this is true of me when I first started a company. My training was at Apple for 7 years before I finally got my green card and quit the next month to start a company. And I took so much for granted from my prior experience. Like I just didn't know what I didn't know about the world, having lived inside the little aquarium of Apple in the 2000s. It's crazy to me how late in the game I learned corporate finance, like principles of corporate finance, gross margins, internal rate of return, these basic ideas.
I have a really funny story about this.
Yeah, I mean, what's your story?
So I was not an investor in Box, but I love Aaron Levy. And Aaron Levy has been an amazing business person. I hope he does not mind me telling this story. But it was after he took his company public that we were like having coffee, hanging out or something. And out of the blue, he's like, Sarah, you got to tell all these entrepreneurs that their job is to create a cash flow generating machine. And I'm like, I went to Wharton, right? And I'm like, I went to Goldman Sachs and I'm like, what do they think the company is? And he's like, I don't know. We like do cloud storage for people. And I didn't realize my job was to make a cash flow generating machine with an incredibly efficient sales motion. I was like, okay, I want people to know this really early. Yeah. That is the terminal point of the company. It's a cash flow generating machine that does lots of useful things for people in the world with an efficient distribution motion.
100%. I mean, I do think that like that in speaking about, first principles, the idea that like the net present value of a company is just all of its future cash flows discounted for time. And it's that simple. And so every proxy that we use in valuing a company, thinking about the multiple on revenue, these are all rules of thumb used to get back to the most fundamental principle of how you value an asset or a company. And for me, my experience was that the minute I internalized what you just said, that what Aaron Levy said was true, that it was about building something that took money in the top and spit money out the bottom, that if you could put $1 in the front of the machine and it would give you 2 out the back, you would do the 2 in the front and the 4 out the back, and you would do that infinitely for as long as the machine would let you do it until it broke. Like then all of the other decisions you make as a CEO and a founder snap into place. That's why I'm worried about my burn rate. That's why I'm worried about my gross margins. That's why I'm worried about getting customers now instead of 6 months from now. That's why I have this sense of urgency to execute yesterday and get ahead of my competitor to this segment of the market, because that's going to translate into cash flow for me at some point in the future. It all became like really clear. And I know I'm not an investor, but if I heard, entrepreneurs using just nice, clean, classic corporate finance terms to discuss the mechanics of how their business is going to succeed, I kind of get turned on a little bit by that.
It is very exciting. And I think especially
rare or
rare actually, because I think there's this balance it is useful to have as an entrepreneur between like putting one foot in front of the other, where like, okay, I'm just gonna like make the quarter or make the next sale or like ship the sprint or whatever it is, right? And that's how we make progress, right? Like we're gonna do one thing at a time and like sell more and make the customer happy. But I think one of the useful things about having investors around who are like, well, I get to think about the company on a 10-year basis because I don't have to operate it, is what does the machine look like as an independent, durable public company? And is there a path to getting there? Because if there is not, maybe you should not do this business, or maybe you should do something else, like sell the business.
I think one of the most enjoyable elements of my own interactions with entrepreneurs in whose businesses I've made little tiny investments is watching them recognize that the game they're playing is not a product game, it's a business game. But occasionally I see founders who just like get it, and they understand that the total game they're playing has got a lot more moving parts. It's much more of a 4D chess than I took an LLM and I built some text processing and I'm going to sell it as a product. Right now, it seems like as an early stage investor, it's really hard to fail in the short term. I mean, long term, the market is gonna sort the coins, right?
Yes,
but like
it will weigh us all.
Yep, it's gonna rationalize at some point. But when you think about, let's say, I think a really successful and a very special investment in Harvey, to what extent did the founding team have an understanding of the game they were playing from the very beginning when you made that investment?
This was a very high level directional thesis, but I think also understanding like what is the magnitude of the opportunity if you are correct is really important, right? Let's say there's many hundreds of billions of dollars of legal work done in the world. If you think you can do some huge amount of that, and this is the best team in the business, like actually you can choose different businesses along the way. And I think one of the things that the Harvey team has been very good at is not being attached to the scope of the original product. Not that they're not great product people, but you could not charge, I think, huge rent for the V0, like, shipped after the first 6 months version of Harvey, because they're just getting more and more ambitious with what they do and how they serve firms and like what it means in terms of business value to their customers.
It's something that I've heard you and also your business partner, Mike Vernal, talk about a lot, is just ambition and sheer ambition as something that is in short supply and something that is an input to the success of a company. And it's sort of, you can sort of at a high level say, yeah, sure, like ambition, but like, I feel like there's a deeper meaning to that concept for you. Can you talk a bit about like ambition and what it is about that element of an entrepreneur or a founding team that like drives outcomes?
Okay, I'm gonna give you like an uninspiring answer to start, and then like one that matters a little more to me. The less inspiring one is just like, if you think about outcomes for a venture-backed company, the two good ones are a premium acquisition or an IPO, right? In order for either of these things to be true, you need to have like a team and technology that somebody wants, or a customer base that is strategic in some way. I'm thinking about the acquisition, or you need to represent a threat, right? Like, and so you have to become that somehow. And when I say premium acquisition, the buyer needs to be willing to pay lots of dollars, and it helps if they are a high margin, large business themselves, right? And so when you think about, most entrepreneurs, when they start, they reasonably start thinking about a customer problem. But when they think about outcomes, that's a very different,
outcome of the company.
Outcome of the company.
Yeah.
That's a very different optimization, right? And we never invest in companies to be acquired. But if you just think about like their acquisitions and their IPOs, you have to be a big company. It is not fun to be a small public company. You need to be big, bigger than you needed to be 5 or 10 years ago to be public. And then like you need to have predictability and visibility into a continued growth path to be valued well, right? And so when I think about ambition, it goes back to the balance of like, new entrepreneurs, so excited, some customer's going to pay them $300,000 for their product. And at some point, they need to make these two crazy things meet, which is how am I going to have $500 million of run rate and growing? Or how am I going to be a premium asset that somebody wants? And so like the tactical answer is like, much of the value creation in technology requires you to, end up in one of these outcome sets. And so for entrepreneurs aiming for that, or wanting to be aligned with venture investors aiming for that, then you got to go from thinking about your customer to thinking about how do I shape my business such that this is possible.
It's glib to say that ambition means, being hungry, or glib to just sort of describe it as ambition and I think not get into the sort of tactical reality of what that looks like in an entrepreneur. And my experience of this is like every single time there's an opportunity to take on more and create more chaos, but also create more growth. You take that opportunity. And for you as an investor looking for that and an entrepreneur, what's the green flag? Like the sort of, oh man, this person has the bug of like that really tactical gut level ambition that transforms the outcome of a company.
Being more ambitious usually means taking more risk, right? Versus like executing on the first thing you figured out as an entrepreneur, which is hard enough, right? And so I think the willingness to say like, in order for this to be the company that I want it to be, or to play at the level I personally want to play at, because there is a lot of like identity and ego tied up in this. We're just going to try the other thing too, or we're going to become more verticalized, or we're going to learn to do new things in the company and just assume that it is possible, because there's no less possible than the first thing.
They can be told that it's not possible. Like generally, like you can't hit 2 balls with one swing, blah, blah, blah. There's so many ways to tell someone they can't go after.
I think this is actually one of the biggest my partner Mike just wrote about this, but one of the biggest like changes in thinking for us over the last few years, the traditional mindset of Silicon Valley was like, okay, do one thing really well, like pick a feature that is like a good wedge into a product, that's a good wedge into a like a, you know, a broader suite that is a good wedge into a platform maybe. And like there's a path to go down that where you have enough focus at your best of breed, right? I think that there are like clearly examples from both the SaaS era and the AI era that just say like, well, this theory has very little correlation with like success and actually what the customer wants, right? If you talk to customers, they don't want a billion vendors for everything. That's kind of like a temporary state. And so I think the fact that the technology like AI allows you to do so much more, the entrepreneurs most aligned with the era are actually the ones who are like, well, if you're going to do that much work for me by giving me all this intelligence, I'm going to continue to do the same amount of work and see what the maximum is that I can do with it.
It seems to me like this sort of end state here is actually way fewer companies, like way fewer large companies than have existed in the past. That there's all that rises must converge, and it seems like you know, the interface layer for the user and for the business is actually going to sort of force us into a position where we're abstracting away a lot of what used to be individual billion-dollar companies. And I have to imagine that as an investor looking at this, that doesn't portend well for returns. That like if you want the huge exit multiple times across your portfolio, that the current state of things is trending toward a much smaller number of much bigger outcomes.
I think this is true in existing markets of software. And I think there are many more markets available to software. So that's like why I'm really excited. It's very hard to guess like how many crazy outcomes there are. There's certainly, I mean, venture has been a outlier business becoming more of an outlier business. So that is true. And you have to be in the right companies and, you know, work on the right areas. But as an example, like I did not, Sierra is more of a bet on Brett and Clay than anything else. But I'd also say from a sector perspective, I didn't spend a lot of time thinking like, I just really want to work on contact center software because it wasn't, and like, I don't say that with any less love than Sierra. We have like a major investment there. It just wasn't, like that important.
But this gets back to what we talked about earlier about like thinking from first principles about the sort of financial structure of a business. Like contact center software historically wasn't super interesting because there weren't really many opportunities to tighten the screws so much that you could drive a ton of value for the customer. Their objective in that segment, in that market, was to save money. Like always in a contact center, it was
they didn't even offer you the opportunity to save money. They just said like, we'll make it possible to make the calls. That was the outcome, right? And I think we're 2 levels up in abstraction with what you can do with Sierra, where the opportunity is like, okay, you are a large bank. We will help you make more money in this path, this transaction pathway with a customer. And that might be like, you know, take out a mortgage or something. And so like, is that the same thing as the contact center market, or is it like a new market? I don't really care about the nomenclature, but I think that there are many more opportunities and there are going to be a lot of actually very large outcomes. In the areas of existing software, there should not be as many SaaS companies as there are.
I want to talk for a few minutes about investors. Entrepreneurs and investors have a relationship in Silicon Valley that's, you know, nothing but this all the way back, all the way back to the 70s. I don't know, like venture capital, Don Valentine, there's like, you know, a whole history here. The dance between the entrepreneur and the investor is a point of interest for me. I'm an independent seed investor on the side. I don't care if I ever make a return on any investment. I'm in it purely for the intellectual sport. You have limited partners. Limited partners are institutions like universities. They might be wealthy private individuals, but they put money in the top of the funnel for you. And then your job is to go be the allocator of capital across Silicon Valley and across opportunities that come across your desk. And there's like, I think, you know, you on your website, you have your beliefs. And in a few of your beliefs, you talk about incentives and how generally the way to change behavior or to elicit the behavior you want is to change the incentives. Can you talk about the incentives you operate under as an investor?
I do think founders overall could spend a lot more time when they go into a fundraising thinking about the specific process that has to happen for them to get funded by a venture capitalist. And it's like my mental framework for this is just like think of them like as like an enterprise buyer, right? There's other parties involved. You have to understand the process. There's some steps in this like pipeline. And the more you know about that, the better. There are personal incentives and there are firm incentives. One of the things that we tried to do when we set up our fund is say like, we want to be aligned with a very small number of companies for the long term that are going to be important. And, you can choose LPs and set expectations with those LPs so that that's true, right? And the expectation from, very large firms over time is that they deploy a lot of capital, get to pay their people more, and are constantly evaluating the companies in their own portfolio for future rounds. That's quite different from a firm that is fundamentally early stage, which is what we are. And I think like all the venture caps look the same to founders. I understand that, but I would figure out like just classify like, okay, does this person want to make an investment at this stage only, or do they want to make an investment like perhaps now and then like the next 6 times I raise money? So I think that's the first classification. And then I would think about like, is this person secure in their own decision making? And do they need to get a lot of other people on board? And how much risk are they taking by investing in me? If you are talking to somebody who started a firm or has fundamental investing self-confidence and has demonstrated it, then it's different than somebody who's climbing a career ladder at a larger firm, for example. And that doesn't mean you shouldn't work with somebody who's climbing the career ladder at a larger firm. You just need to understand it.
Right.